Hams,
Here.
Phil
Still here.
DeFonso.
Here.
Thank you both. Timothy Hodges,
Here.
Catherine McKinnon,
Here.
Commissioner Perez,
Here.
Franklin Perry,
Here.
Chelsea Ross,
Here.
Sarah Sanders.
Here.
We do have a quorum in attendance for the meeting, and I just do want to remind folks that we are live streaming and recording this meeting. Both of those have already started.
Thank you. We have two action items and several reports. Let's begin with the first action item for the next bond sale. Hazim.
Good morning, everybody. Nice to see committee members in person. So this morning, finance, we do have two action items. The first one is regarding the bond resolution. So the resolution is to authorize CHFA to issue up to 325 million of the housing mortgage finance program bonds in one or more issuances. The sale will allow CHFA to raise additional lending proceeds and fund about 1,500 first-time homebuyer loans. As of November 8th, CHFA had an aggregate net pipeline of about 320 million. Based on the interest rate environment, CHFA would utilize a fixed rate structure and expects to close the issuance in February 2025. To leverage CHFA tax-exempt issuance capacity, CHFA intends to pair the tax-exempt issuance with taxable bonds. CHFA has informed RBC to lead the first financing. I'll be happy to answer any questions regarding the resolution.
Like a standard bond issue to me. You do these 4 times a year, right? Is that
Yes.
Okay.
like
Give
clockwork?
or take. And I think, part of it, and I believe we discussed about it, that is a good way in terms of how we manage interest rate risk and our pipeline. We don't want to sell too much, and then we don't want to sell, too little, because you don't want to be over or unnecessary. You just want to time it. So we would try to adjust the size. The timing, we have it nailed down, but the size, we try to adjust based on this.
You're gonna go after Thanksgiving, but before Christmas in that window?
No, we plan to print sometime in January.
Oh, okay.
Yeah. Because we don't have a December meeting, so that's the reason why the resolution.
That's what you're in now, got it.
Yes.
They're trying to squeeze it in, okay.
Yes.
That's curious. I'm not saying it's a bad idea, but you're saying you decided to go with a fixed rate
Yes.
because of the rate environment, but the rate environment is very somewhat unstable, right? But it's gearing down.
Correct.
So you talking about that.
Yeah, so
And I'm not saying it's a bad idea. Just curious.
yeah. So when we sell bonds, one of the things that we try to very first to solve is the match funding. And because the only thing that we do is providing a 30-year fixed rate bond, we like to at least determine what would be our cost of capital. And in the current rate environment between tax-exempt and taxable, issuing tax-exempt fixed rate provide us with that full spread. So there isn't a need to go fancy issuing variable rate debt because issuing fixed rate already satisfy and meet your mission.
Now, the one thing that issuing taxable along with tax exempt does, is it does raise your borrowing cost. But just as an example, and you'll hear about this later today, we've taken 200 and something million of tax exempt borrowing authority, and we've issued $800 million worth of bonds. So we've had to make up for the volume increase this year due to time to own and other resources by issuing taxable debt. So it has raised our borrowing cost. Potentially, if we had more tax exempt authority, we'd have to issue less taxable. You could either pass on those savings to the borrower or create 0% subsidy, which we could then use for programmatic purposes when rates go up, or if we wanted to create special programs like that.
So this will have we have the ability to pay it early? Like
Yes.
So the rates do really go down.
Yes.
And we reach whatever the magic number is.
Correct. And that's part of the whole exercise, and then Jeff can speak a bit more eloquently in terms of how the market perceive housing bonds. That when issuers of housing bonds, we do sell with an option to call the bonds early because we don't want to, correct.
Make a rate because people.
Right, when people prepay, you're sitting on that prepayment and you do want to have the option to call the bonds. At the same time, the flip side for issuers, you are in fact paying a charge because you're buying that option to have the bonds be able to be called early. So that's why they call it the housing penalty because you would like to have that option built
That
into.
should be like big payment penalty.
Yeah.
People like housing.
Yes.
Has even when RBC does their pricing book, if we could include basically the historical spread to MMD. for
Oh, yeah,
the-
no. So when Morgan Stanley is presenting their stuff, that comes there. So it's something that we are encouraging the lead bank to do, provide.
Excellent, thank you.
Any
Questions? May I have a motion?
Move.
Second? We're gonna have a verbal vote. All in favor?
Aye.
Aye. Any opposed? Abstentions? The item passes. Next item is the.
Madam
review
Chair,
of the-
I apologize. This is
Oh.
Dawn. Just for the record, could you name who in the room made the motion and seconded it? My apologies.
Tim Hodges made the motion.
George Perez second.
Thank you very kindly.
Next item is review of the budget.
Good morning again. On October 31, we provided and presented a draft of the 2025 annual budget totaling 50.3 million to the board of directors. Of the 50.3 million, 32.4 million is for salaries and benefits, 12.9 million is for general and administrative, and 5 million is for capital expenses. Additional details and explanation were included in the presentation. Since that presentation at the last meeting, we finalized our net earnings calculation and updated the proposed lending plan accordingly. We also increased the annual budget amount slightly by 50,500 to account for a higher trustee fee. And then finally, we did not receive any comments from any board members regarding the draft budget. In summary, the 2025 operating budget is 5.5% or 2.6 million higher when compared to the 2024 budget, of which the budget for salaries and benefits, which includes a 6% allocation for COLA merit, is 163,000 higher than the prior year. The budget for ongoing general and administrative expenses is 454,000 higher than the prior year. And the budget for capital expenses is 2 million higher than the prior year. So I'll be happy to take any questions the committee has regarding the proposed 2025 budget.
I forget what the percentage was, but your French benefit,
Yes,
I think it was something like the twenties.
30s,
I cannot forget the rate.
30s.
Huh?
I think it's in
the French in terms of overall is 29.
Okay, that wasn't fun. But I thought you got your French from the state.
Correct. So the state actually lowered it for
Yeah,
this
all
new
the
fiscal year,
projects.
yeah.
So it wasn't the 30s.
It was.
No, actually, at one point it was in the seventies.
I know, I was sure. it was
No, I mean,
30s at one point.
at one point it was in the seventies, so that's why. I was-
Oh, no. So that's let's clarify.
Well, I meant
So
to-
the French, when it comes to salaries, it used to be in the 90s.
Like, and then, wow.
And then now we're saying it's in the 80s, so about 85, 86%. So for every $1, we're paying now. like
So what's
about
this
85.
percentage you're talking about?
So the 29% is based on the overall stack. So based on the 100% for the
Which is
budget.
misleading, because some of that really,
Doesn't get French.
right.
Right, but the idea is just trying to say that the overall cost to operate CHFA, 29% of it is funding.
But I think it'd be more transparent if we could, because that number could be misleading, which was my point to bring it up.
Oh, so if you go to
Actual
the
cost of French benefits is not 29%.
right,
It
but
may be of the overall budget, but there's stuff there that like Nadeem saying that doesn't.
Right. Right. But if you go to the budget explanation page, under the French, I did explain that.
Right, I
Yeah.
mean, that will require someone, like for instance, I need.
Right.
I'm gonna have my percentage over here.
Yeah.
But the general public are not gonna know how to navigate that. Someone that does this every day.
Yeah.
So my point is simply more
Yeah, we can,
transparency purposes,
Right.
that's all.
yeah, I did include an explanation in the back, I just.
But
I
your
just
general
can't-
public,
Yes.
that's not gonna
Okay.
know. You're not gonna understand that unless they do this for a living.
Maybe where you put the 29%, you also say 29% of total, but 80% of salaries and benefits.
Something like that,
So that way you have both numbers.
And do it,
Yeah.
and do it upfront, meaning don't force the
Yeah, no,
reader to have to
the
dig for it.
information is in there, it's just that.
But you have to
the
dig for
numbers.
it, and what I'm
Right.
saying is the average citizen or the
Right.
average person.
Yeah.
Not gonna dig for it, right, or report it, right? Reporter, we're getting recorded, so I'm gonna be like, reporters, they like you to do the work.
Right, yeah, right. Understood.
I just
Yes,
had a question on, and maybe that, I try to read the explanation of mortgage interest,
yes,
interest on loans.
Yeah.
And I didn't understand it, but it's, I looked at, like, when you look at interest, and then I look at investments, and then I look at the bottom line,
Mhm.
the projection, is it inverted? So then investment income goes up when interest rate income goes down? Because I see, you know, like, cause when I look at like $182,000 of projected budget of interest on investments, if that correlated to like what projected is this year, we're gonna lose a lot of money. Do you know what I'm saying? Like,
yeah,
like if you look at like, it's 113 million of projected interest income. And then it's 159 million of investment income in projected 2024 actual. And then you look at like 110 million of interest income in 2025 and 182 million of investment income. If your investment income went from 159 to 182, are you, I guess I'm just like trying to figure out
Yeah.
how we come up with those numbers, if
Yeah.
that makes sense.
yes, totally makes sense. So you have to step back and look at what those numbers consist of.
Yes,
So one of the things that when we report mortgage receivables, is not just reporting on the first lien loan, it's also reporting on other loans that is on our books, what we are servicing,
okay,
okay?
Yeah.
So when it comes to the first lien loan, it's primarily either for multifamily, which is growing ever slowly because you know, we only do closing so many times a year.
and of that breakup, multifamily is 55%?
Yeah, multifamily now is like about 1.5 billion.
Okay,
Of which only about like 800 million is financed by bonds, 700 million is, you know, other assets.
Okay.
You know, such as like IPA.
Yeah.
And the likes. And then single family is about like 1.1 now.
okay,
And what's happening is, you know, as the program and as we attract more lenders to originate our homeownership loans, they are generally non-bank lenders.
got it,
So they don't hold their loans on the balance sheet, they don't service their loans, and they would like to put it into a security. So when they put into security, it goes under the investment category.
got
And what would happen is over time, the mortgage receivable balance will go down. Simultaneously, since last year, we started adding, say, time to own. And then time to own now goes on the books, but time to own doesn't receive any income.
Got it.
So when we book it, it's just like the principal, but the principal is
So the investment income is made up of the securities of
Yes.
people who are not servicing, and that's why you're projecting it to increase versus if
Right.
we're. Because I was
Right.
just looking at it saying, wow, that was like
Yeah.
a big jump from one,
Right, yeah, it's not to say that it is inverse in terms of the presentation, but the reality is we are substituting mortgage receivable with subordinate loans
got it, yeah,
mostly.
Yeah.
And because of that, it's either carrying, you know, 2%, 3% or less.
Yeah. got it, okay,
Hazim, I
Yes.
noticed that, so the operating budget is 55 basis points of program assets, which is 3.3 basis points lower than the 2024 actual.
Yes.
Okay.
Again, as we add
As you add
more
assets,
assets,
yeah.
and then as we expand our programs, whatever programs that we
That should
are
go down.
managing. Some of those assets, we are managing at cost or even at a discount. And that's pretty much it.
So as long as our activity goes up, that number trends down, and then when our activity goes down, that number trends up.
Correct. But that goes back to the original concept about leveraging. So what we're trying to do is whenever there's an opportunity for us to manage a particular program and pair it with what we have. So for example, when we undertook the TTO program, it's not like we're just running TTO independently. It's paired with our first mortgage. So we are effectively servicing or administering the program for TTO. If you look at it independently, it's for free, but because it's part of the single family program, we are leveraging.
There's a related.
That's a related,
conventional
there
loan
is that
effectively,
synergy.
yeah. So you're actually basically more leverage per client. And-
Correct.
And so from a servicing perspective, you're getting increased operating leverage.
Correct.
Yeah.
Yes.
That's why you do that. Okay.
It's expected.
So
Can we
you
go to
put this
page-
budget.
Oh, I'm sorry, okay, go ahead.
You put this budget together in October, post-election.
Yes.
I mean, are there anything in here that you're particularly tracking? I know you're sort of in tune with legislative changes. Are there anything, I should be concerned about?
I wouldn't say concern. I think just mindful, right? And if you look at the memo, I started off by talking about the interest rate environment. Because at the end of the day, we are a finance authority and we rely on interest rate on both sides. So we're trying to make any financing work, whether for multifamily or for single family. And part of the interest rate calculation, it is based on how you generate that proceed, that interest. So Nandini mentioned earlier on about tax exempt, but that it has only a limited capacity because it's governed by the state. So if in an event there's a disruption for whatever reason, then we do need to pivot and we do need to change how we offer our loan products. That may not be conducive to get to a closing, because then it would just create gaps. And then when you have gaps, then there'll be some expectation that we have to deploy resources that may then result in lower production. So that I think it is the one that the thing that we're mindful about. The rest of the budget is more about an expectation that we have an ability to go after our stretch goals. That if things, I wouldn't say remain normal in 2025, but say that if there's certain things where we still have a good handle on when it comes to private activity, the interest rate environment, the geopolitical, they don't go out of whack. The capital markets, it does not freeze and we can still access, then we should be able to go after.
I mean, so we're gonna have a discussion about this later this morning. We're gonna have a guest speaker at the retreat. But one of the things that he's gonna talk about is sort of what might we expect in the new administration from their priorities, but I think we went to an investor conference just the other day and they were Morgan Stanley and they were talking about how soon could we expect, of course, nobody really knows, but how soon could we expect a tax package? And so that could have huge ramifications for our tax credit program because if corporate tax rates go down. We saw this happen in 2017 or whatever. There was definitely a decrease in the appetite for tax credit investments. It does affect how all of these multifamily deals work and how effective they are, and that may require us to come up with different resources. We'll never be able to make up for a loss of equity that's, 2 or 3 cents, right, for a $20 million transaction, but every dollar helps, and so that's the kind of thing that's a little bit unknown at the moment. I mean, will they claw back IRA money, that's unused? Because we've been looking at that as a source of funds for the sustainability measures that a lot of these transactions are trying to have in their redevelopment, so there's a lot we don't know, but I think given what we don't know, we have a tremendous amount of flexibility to pivot.
Or how the rates behave,
Sorry?
or how the rates are gonna behave.
Right.
Because they're not
The
being
bond markets,
traditional, right, because.
Right.
Prices have been cut 3 quarters of a point, but mortgage rates went up,
Right,
because it's the treasury.
that's right,
The 10-year treasury is really,
right,
the 10-year treasury is starting to build in tariffs, or the fear of
Right.
tariffs.
Budget deficits.
Right.
yeah,
Which, I'm getting complaints from people saying, why mortgages are not going down, right?
right,
I go, first of all, I have nothing to do with it. Go to the bank and tell them they have to lower the rate because the prime went down, right?
Yeah.
So they want me to order banks to order.
and that's the other reason, fixed rate bonds while we can.
So I
You know?
have a conversation with them saying, well, it's not the prime
Right.
really. Traditionally, they both behave the same,
Right,
but there's the big unknown now.
well, that's the other reason to do fixed rate debt while we can. Because you wanna save
But it's a gamble,
your
because-
weapon of choice, like your variable rate, that kind of power for when you really need it. And so right now, we can do full spread transactions, that don't require variable
Well,
rate.
I agree in this market, it is, but I don't agree that normally.
No, I'm just saying, like,
It is a gamble, right? But,
Either way, it's a-
but it's a gamble,
We have to
but,
go back. So,
but the fact is that you know what you're gonna get, right?
Yeah.
Versus another time where you could actually go down. It's a gamble I would probably take as well.
Well, by the way, we kind of like gamble to swaps,
right, we
so.
do synthetic
either way you
fix
pay
them
for it, one way.
and,
Right.
so there's other.
We're always in the market. We can't avoid interest rate risk.
Right, but
We're-
no, but you
we're
minimize
adding-
interest
Yeah,
rate
we're
risk.
adding assets and we should be balancing it. So,
Right.
interest rates can go up and down and there's nothing we can do about it.
I totally agree, but the point I was trying
George
to
can do something about it.
the point I'm trying to make is that because of the change in national, of the perception that's gonna be this major
Yeah.
change, rates are actually behaving differently than they do
Mhm.
before.
I mean, hopefully the fact that housing is at near the top of people's priority list will.
And I think it is,
Bipartisan,
just because, it's expensive everywhere.
Yeah.
It's impacting everywhere, and then, Jeff can talk about what he's seeing across the country. Is because of it's a national issue, and that's why many HFAs across the country are issuing housing bonds because the demand.
And I think it makes sense to do it now, but yes, people make it a priority, but then listen to what they're saying. If you're gonna make it more, if you're gonna make wood more expensive, if you're gonna make sheet rock more expensive,
Labor more expensive.
more labor more expensive, you could be all for affordable housing, but your actions are doing the opposite.
There's nothing to fix all the other ills, and it's hard to do that when you've got all these other.
But even if you
competing
don't,
pressures.
even if you don't take that into account, that's the fact that if you're gonna do towers, right, and you're gonna steel and
Right,
wood and other stuff from outside, and it's gonna cost you an extra 40%.
yeah,
Somebody's gonna pay for
That's
that,
right.
and it's not the developer. And it's not the bank who's taking the hit.
And I'd argue also just giving people more money, if you're not gonna increase the housing stock, doesn't solve the problem either.
No, and it's only so much more money you give people before inflation goes out of hand. The last 4 years proved that, right?
Exactly.
And I'm not.
You have, Sarah, you have a
I
question?
don't think you need to be in a
Page
conversation.
7, because I think it's page 7. I wanted to make some high level observations about the budget and of the HFA budgets, if I'm
Sure.
I think I bring it up every year, but
You're the chair. Chair prerogative.
while we're waiting, this is Tom Kane, our financial advisor, Kane Miller Associates.
Right, sorry, I'm late.
page 7, is there any way we can go?
Lorraine, can you,
It's like this table.
yeah, it's the table next one.
I think it's a good summary
Is this the one, or you are talking about the
Yeah, that's-
detail?
No, this one.
Yeah, yeah.
So, you know, what I've noticed since I've been on the CHFA board is that we always have pretty conservative budget, I think.
Correct, yes.
And if you look like our budget for 24, we thought we'd have net income of 16.8. And where it looks like we're gonna be at 28, you know, almost double. And that's been a trend, I think, which is a good trend, you know, better than the other way.
Unless you do it on purpose, they get bonus.
And, but then when you look at the revenues and expenditures for the new budget, they're a little closer to our actual than the last budget. But again, so now we're anticipating net income of 13.9, and I'm sure we're gonna be at 26, probably 26 by the end of the year.
Well,
But-
and that's part of the reason, in the, memo, we did explain that we do have that cushion
Right.
to manage.
And every time I ask about this, Hazim, you go through I think it's part of the resolution, it's part of the
Yes.
reason that we budget the way that we do. Maybe if you could just,
Yes, from the standpoint of, the resolution does require that the budget be adopted before December 1. The budget can be amended. Okay, but our intent has always been that, when we come out and we present something to the board, we believe that this is something that we can work with for the rest of the year. So we prefer not to go back to the board and say, hey, by the way, we were running out of cash, and can you amend the budget? So that's number one. The second one is more of a administrative reason. And it's because the way the resolution operates is when we fund the budget, we have to fund based on a 1/12 calculation of the amount. And some of the expenses that we incur, it comes in slugs or a big chunk. So we have to manage that liquidity to ensure that we are able to pay for those expenses. And last but not least, again, this is just the way we approach it, is if in any event we don't spend it all, it just goes back into the waterfall, and then we put it into the ITA or the opportunity fund. So that's just how it works, yeah.
and then my other observation was that, compared to last year's budget, operating revenues are 50 million higher, and operating expenses are 50 million higher. And is that just because we're doing more business?
Yes, yes. So there is that relationship between adding new loans or investments on our books, you know, just like the question that Phil mentioned about the relationship between interest on receivable and interest on investment and the funding source. So for us to meet and provide the proceeds for us to increase production, we have to sell more bonds, and that's the reason why. And then of course we are selling more fixed rate bonds.
And then I just note that our budgeted operating revenue and expenditures is closer to the actual for 24 than the budget.
Yeah.
Just some observations on a big picture basis, but.
Yeah, what I would say that, you know, one of the things when it comes to the 2024 budget, budgeted amount and the actual amount, I don't mind being wrong on this one, which is that when we did the presentation back in 23, we didn't anticipate our production, at least in the single family space, homeownership space, was going to be the way that we saw. Like we're probably going to hit a billion, very close to $1 billion in production for single family. When we did the presentation back in 23, we were only thinking about 600 million the most. So that's a mistake that we welcome because it seems, you know, it's something that is in our favor and we are helping the residents.
What's the comparable number for the 25 budget?
The 25, we are projecting 750 million.
Okay, somewhere in between.
And the reason is because part of the increase in production this year is due to TTO. And TTO in turn, you know, going back to the biennium budget of 23, it does expire June 30th of 25. So we are trying to hedge our bets in terms of what we think. And if you look at the memo, we did say at least 750 because we don't know. Like it can go back to what we experienced. But if in any event something happens or there's lack of support to provide the subordinated debt, then we do believe that we're going to experience a dip.
To be clear, we're gonna try to get TTO.
Right.
We just don't know the level of funding.
Right.
That we're gonna get, and will it be equal to 75 million per year for the next 2 years after that? It's unclear.
But will it use whatever that's outstanding in time zone will be used
Oh, absolutely.
Yeah,
through
for
the
sure.
thing?
Absolutely.
But won't that, because you reduce the time to own from 50 to 25,000, won't that? So is your 750 million being like a little bit conservative because spreading it out over a greater group?
Yes. But then, and again, it all comes down to, so 750 is based on the principal amount. And one of the things that we did see, when it comes to TDO, what it did help
Reduce
was
that.
it allowed people to get a bigger loan.
Yeah.
So you reduce the 25, then in theory, it may impact the size of the principal.
The first.
So,
But not everybody got 50 anyway, right?
not
It
the
don't have to
average,
be
the
in
average is 31.
Yeah,
The average is
Before the change.
yeah.
before the change.
Any other questions on the budget? May I have a motion? Motion
Second.
Jerry Abrams, second.
It's Tim.
Tim? I'll have verbal vote, all in favor? Any opposed? Any abstentions? The item passes. Next item is a report on the last bond sale, which was the best bond sale ever.
Everyone is, right?
Right.
But most recent one is the best. Most recent, entity representing.
So- So let me say, yeah, so this is the 2024 F is our last calendar year to 2024 bond sale for single family. And as we discussed last month, we did assign this deal to Morgan Stanley to work on it. And Jeff is going to go into detail, but then when just be aware that when we selected the pricing date, we were trying to hit a closing date prior to November 15, and then November 15 is because that's the date where we are required to close for us to preserve any prepayments. And when you have a closing date that you cannot move, then you have to back into when you need to sell the bonds. And because of the noise surrounding the election, we picked the week that we sold, and that there was headwinds. So Jeff, why don't you take over?
Absolutely. And just to, that's a really good setup, especially in relation to the upcoming bond sale. And then also what to expect for 2025, because I think everybody has a lot of uncertainty about that because of the result of the election. But in terms of supply and why we think it's a really great strategy to get into the market in January, is that this year has been a record year for housing bond issuance. So we're currently at about 42 billion of housing bonds that have been issued year to date. Last year, we were in and around that same range too. So the last 2 years have been big years for HFA production. And the reason for that is that the market has been very conducive for funding out of bonds as opposed to selling the mortgages to the market. This type of deal that we just sold into the market and the one that will be coming in January will be similar, tax exempt, taxable. And I think to answer George's, the commissioner's question, why that and why fixed rate? You're not alone. So with that 42 billion that's been issued this year, it has been primarily fixed rate and divided between tax exempt and taxable bonds. And so in the marketplace over the past 2 years, you've seen an increase of tax exempt issuance of about 25-30%. Taxable issuance over the past 2 years has increased 275%, just to give you an indication. And to give you an indication of the frequency that taxable bonds are being issued across the market. So CHFA is right there with the rest of the group and leading it too. And leading it with a sale like the one that we just brought in the middle of October, and Hazim's comments about supply and demand and also how that relates to January. When we priced these bonds, there were a lot of bonds that were being sold on the market. And that makes it such that it is a little bit more difficult to bring the bonds to the market because of the reception from institutions, not necessarily from retail. Retail tends to be very interested in the bonds because of the excellent credit quality and the rates. In the institutional market, when they see a whole slew of different deals to pick and choose from, that makes a choppier market. And in January, we do expect that the issuance rate is going to be substantially lower. Historically, January is an excellent month to price bonds for HFAs. One of the reasons is that you have all of the multifamily issuers issuing year-end transactions in November and December. Those issuers don't come to market in January, generally speaking. Single family, similar kind of a phenomenon too. So really, excellent strategy. And I think it's probably on the advice of King Mitter to do that as well. In the transaction that we just brought, this was in the context of not just having to close by November 15th because of the volume cap issues and preserving the retiring cap, but also the election. So what has happened cyclically in election years is that there is a swell of tax exempt paper that comes into the market in September and October. And then in November and December, there's a back off substantially. And you can see that if you look at the data from 2016 and 2020 and other election years. In the housing space, it's not quite so pronounced, and that's because multifamily issuers have got to get into the market because of tax credit allocations and still do deals in the December timeframe. And this year is not going to be any different from that. So that to say, looking at the pricing book and going to slide 4, this is a summary of the basics of the transaction, and the thing to focus in on is the supply in the weeks preceding the election and when we price your deal. And so week of October 14th, that was a holiday week. So issuance for housing, not pronounced in the general markets. The total volume was about 15 billion. That's an elevated week in the municipal market. The week of the 21st, when we priced the authorities' bonds, also an elevated week with 13 billion in the market. And when you're thinking about a sale that's coming into the market, you look at other HFAs that are there and competing credits from that perspective, but you also look at everything else that's being offered too. And one of the big reasons for that is the investors, when they're focused on other things, investors that buy housing also buy other credits too. The week of October 21, 1.2 billion of housing bonds that were being offered to the market. That's a lot. So when you think about a typical week that's heavy for housing issuance, that's something that looks more like 600-700 million. $1.2 billion was a lot, and that means that there were a whole bunch of different deals in different shapes and sizes that were being offered to the market. The week before the election was also an elevated week. So the choice of getting into the market pretty much was those 2 weeks in order to hit the November 15th closing date. So, pick and choose. And both of those weeks elevated and felt similar challenges across the board. In terms of the overall transaction, you can see that the split is 206 million of tax exempt, 92 million of taxable. We've talked about how that is now somewhat typical in the marketplace, and we would expect that that's going to continue into 2025. the reason why I say that we expect, and Morgan Stanley would expect that it continues into 2025, is that there has been a bit of a shift in the point of view on what the Fed is going to do. So just as we were getting into the election and then after the election with the result, consensus on what the approach will be from the Fed has shifted, and it's moved from more cuts to fewer. And so our call, and we just released our the Morgan Stanley Economic Outlook for the coming year just before our housing conference that we hosted, which was super good timing. So that came out on the 17th. And our call is for a cut in December, 25 basis points, and then 3 additional cuts in 2025 with a terminal rate of 3 5/8. A 3 5/8 level in the current market with where mortgages are and how we would think the tax exempt ratios will play out versus taxables will continue to be conducive in that rate environment. So we are not expecting that we're going to be reverting back to the super low interest rate environment that we saw, in the 5-6 years ago. So that's just something to keep in mind. On the sale itself, the pricing supply and the supply in the market was a factor also leading up to the bond sale. Remember that the Fed had cut its rate by 50 basis points, but treasuries had moved, but MMD, which is the tax exempt index, doesn't necessarily move in lockstep with treasuries. And in addition to the supply, there was a fairly sizable correction in MMD that week on Monday, Tuesday, Wednesday, in an aggregate of 30 basis points adjustment to MMD, which is substantial. Taxable, first on the taxable pricing results, that part of the sale was, I think, extremely good. We saw strong demand across the board for the structure, which was divided between serial bonds and a PAC bond. So the results allowed for tightening of yields and spreads on 28 million of bonds, and then the PAC bond outperformed all other issues that week, which was good, because one of the things about the PAC bond structure is that there have been pockets of challenges throughout the year, not for this one. CHFA's bonds outperformed all of the other issues, including AAA issuers from other states. On the tax exempt side, the MMD increases were not helpful. And as a result of that, we had strong retail demand. We had 53 million of direct retail orders, and we also had a good support with about 30 million of professional retail. But the institutions were cagey. That's what happens when you get into a market with a lot of supply and you have these big adjustments on MMD. We did have to increase spreads on the term bonds to meet the market. And Morgan Stanley underwrote almost 46 million of bonds to make the transaction work and to bring it through the market. We are providing a couple of pages here that are a little different than what we usually bring into a pricing book because of the circumstances of the market just ahead of the election. And for your information, on page 5 of the book, we can flip to page 5. This just goes through the MMD rate movement that I was mentioning. And again, this is like significant. 30 basis points in the course of 3 days. Those changes have not happened more than once since COVID. During COVID, we had major adjustments to MMD, and we actually had a freeze up of the market. So this was something that everybody was looking at, and all eyes were on this. Other names that were in the market are in the chart on the upper right. And so you can see that this was a lot of activity that was coming through the market and a variety of different transactions doing similar types of deals, taxable, tax exempt, and we've broken that out just so that you can see how that breakout flows and the use of taxable bonds by other issuers as well. The next slide is also informational and something we don't usually include, but felt like it would be of interest for everybody. And this is the market movements up to the election and how we think about that and what to expect. The bottom right-hand side does a comparison of the 2016 election to 2024. We felt like this would be of interest and helpful to everybody. What happened is rates increased substantially from the September lows up to the election. And then the day after the election, there was a substantial increase across the board in MMD and also taxables. Bringing that forward and also in support of business as usual to a certain extent, MMD has subsequently come down. Taxables have remained elevated, but ratios are performing and continue to perform very well. Ratios are a key indicator that we look at as to the effectiveness of tax exempt pricing. So we see that, and that's continuing to hold. And after the election in 2016, there was there was upheaval in the market. The market is orderly. Deals are coming through the market. They're performing very well. The retail space is continuing to perform. An example on that is Mass Housing brought bonds last week, and Morgan Stanley retail orders on it alone, direct retail, was 17 million. So the retail that CHFA has experienced over the course of this year has been, I would say, characterize it as excellent, both from in-state and national retail investors. With the rates, with the terminal rate of 3 5/8 in 2025, we're expecting those flows to continue. And we also expect that folks are going to be super interested in putting money to work in this type of credit quality with the tax exemption. People are going to be concerned about tax exemption on a go-forward basis and will be looking to shelter more of their money to the extent that they can. On the MMD spreads to MMD slides that we always show to everybody, on page 7, despite the turmoil in the market, the first slide is the tax exempt spreads to MMD. You can see in the dark line, and it's like a small line because we only had term bonds in the structure. The performance was very good on a spread basis. Similarly, turning to slide 8, and this slide shows the taxable structure. And the front end, you can see, and then there's a gap. There's a gap because there were no traditional term bonds. There was just a PAC bond. This shows that the spreads to treasuries were in line and performed well on the taxable serials. And on the PAC, you can see that the dark blue line is below the others. So as I was mentioning before, the taxable PAC bond outperformed. And with that, if that was a lot. So if there are any questions about the sale or Morgan Stanley's expectations about 2025, I can elaborate on any of that if you'd like.
Well, I'd like to commend you for the underwriting. 46 million, did you say?
We're always happy to do that.
It's so important to have a strong underwriter that's willing to do an underwriting, because your only alternative is to really increase the spreads to clear the market. And I think it's very healthy to have underwritings, and particularly, it happens in a tough market, but it's why you want to do a negotiated sale versus a competitive sale. And so that's important for you to bring your capital. Great. And, especially in a tough market. So just a comment.
So I just want to point out that our change did not impact us negatively, by changing the entity that did this was. In fact, it might have impacted us positive because of them bringing the capital.
Yeah, I hate
If there was some concern about that.
I hate when I agree with Sarah. It's like we hate seeing it oversubscribed. To me, that
Right.
just sounds like it's cheap,
Yeah,
right?
Right.
And I'd much rather have
2 times is better.
Yeah, I'd much rather have it, less and have someone take bonds down, because then I feel like we've gotten our money's worth.
Right.
So, yeah.
Yeah, the market.
But it could also be that we are considered to be the Cadillac.
Yeah.
Yeah,
And they
but
do
then-
pile on, orders do pile on. So sometimes when you're 6 times oversubscribed, everybody knows they're not getting all their orders.
The institutional investors aren't dumb, so it's 6 times
Yeah.
oversubscribed. It's the problem.
Any other comments?
Thanks for the opportunity, as always.
I have one comment away from the sale, and again, Sarah, I think, I've said it on the sale, but just away from the sale and just in general, I'm hearing some, tax exempt market participants have shared with me concerns about, the, changes to tax exemption as part of, a bill to make the 2016 to 2017 tax cuts permanent, and wondering if you had any comment on that, knowing it's completely speculative.
Yeah, definitely. And so we just came off of our conference for housing. We did an affordable housing conference at our offices in the city. Anthony and Hazim came, which was great. We also had we had a total of 15 issuer clients that came. I think that the timing of it was particularly good because of what you're raising with concerns as a result of the election. And we had 28 investors, institutional investors that came to the conference too, which was an outsized performance on RSVPs from investors. For that type of a conference, you would expect to get, maybe 10. So how we perceive this is that all eyes are on housing for a variety of reasons, and we were very encouraged by that. The view on tax exemption and whether that may be in the crosshairs is a good one. In 2016, it very much was. And we spent an enormous amount of time on it. And we spent time on tax exemption generally, private activity bonds specifically. One of the things that does concern me about the focus on private activity bonds is that it's complicated. So you have to have people that are willing to dig in and understand the nuances about private activity bonds and also how that impacts things that are incredibly important. Hopefully people will acknowledge and focus on the most successful P3 ever in the low-income housing tax credit, and it will look to not only defend that, but to increase its capacity. That may be a good result. We'll have to see. There are plenty of people that are focused on this and will be. Our question, and there's a lot of chatter on how quickly the proposals are going to come forward. We think proposals are going to come forward quite quickly, but as far as anything actually happening, we think it's going to take a while. And that's based upon historical approaches, but the tax bill is expiring at the end of the year, so they'll have to do something before the end of the year. All of our folks at Morgan Stanley Research do expect that because of the thin margin in the House, even though you've got, the sweep of the Senate and the House, that it's going to take longer than an immediate, push on this. So we'll be super focused on it. And I think so report back, as the year progresses, and we'll be providing, all of the information about what we're seeing as well will be NCSHA for sure.
Great, thank you.
So, I'm sorry. So we've got a Republican House and Senate, but you think it's going to take longer?
We think it's going to take we think it's going to take longer than an immediate slam dunk.
Okay.
And because of the margin in the House.
Okay.
So you're going to have a lot of people that are fighting against this and expressing themselves and pushing on the programs that make sense. One of the other points here that we haven't seen where it's going to go yet. Last time around, we had a quite inexperienced person come in to run HUD. That will matter. So whomever is chosen for that role is also going to signal us in one way or another too.
I'm sure we'll talk more about this in the strategic
Yeah.
planning session. So
Yeah.
let's get to our next report, financial report, Allison Murphy.
Good morning. Before you are the October financial reports. The revenue side, mortgage loan and investment interest revenue are coming in 25.4 million above budget through October and 31.5 million higher than last year. The year-over-year revenue variances continue to be driven by the increase in investment interest income due to the current interest rate environment. Fees and other income are 7.9 million higher than budget through October and 8.5 million higher than prior year. As I mentioned last month, the large increase in single-family production that we're experiencing this year has resulted in an increase in fee income associated with the single-family program. We are also now earning administrative fees for managing the Built for CT program. On the expense side, bond interest expense is 14.4 million above budget through October and 26.1 million higher than prior year. The outstanding bonds of the authority at the end of October were 529 million higher than the same time last year. Plus, we're seeing higher interest costs on our variable rate bonds. Servicer fees are 9.5 million above budget through October and 7 million higher than prior year. And again, the increase in single-family production is driving this. Administrative expenses are coming in 5.8 million below budget and 336,000 higher than last year. And when you exclude salaries and benefits of 24.6 million, the current year expenses are 112,000 lower than last year. And lastly, the change in net position is above target by 13.8 million. I'm happy to answer any questions.
Outstanding year.
Yes, it is.
Any other questions for Allison? Let's move on to the production and delinquency report. John Chilson.
Good morning. So as Allison said, the production, loan production for single family home had remained strong for the month of October. The authority purchased 301 single family loans totaling $84 million. That's 5% actually less in loan count, but 13% more in dollar value. And that's because the average loan value is up 19%. The average loan value this 300 loans was around 278,000. 97% of those loans were securitized. That's 292 loans totaling $81 million. The remaining 9 loans for $3 million were whole loans. The mortgage-backed security portfolio balance ended October at $3.3 billion, which was an increase of $66 million over September. The whole loan portfolio in September declined by 53 loans to or $66.6 million, ending with a portfolio balance of $1.1 billion. The single family overall delinquency rate was 5.3%. That's 55 basis points less than the state average. And the carrying balance for loans and foreclosures declined year over year by $1.1 million to $12.5 million. And there were 12 fewer loans in loan count. And for the month of October, the authority also funded 186 down payment assistance loans totaling $2.2 million, average loan size 11,700. And 96 time to own forgivable loans at $3.1 million, average loan size was 32,000. And for the multifamily portfolio, there were 6 new loan closings in October. The overall portfolio increased by 2 loans to 595 loans, totaling $1.4 billion. There were 6 permanent loan delinquencies. That's less than the prior month. And there were no construction loan delinquencies, and the overall delinquency rate was less than 0.5%. Questions?
Seeing no questions, then we move to the last item, which is approval of the minutes of the Finance and Audit Committee of October 31st. May I have a motion?
Moved, it's Tim.
Second, George.
Any discussion? Verbal vote, all in favor, say aye. Aye. Opposed? Abstaining? The minutes are approved. That's time to adjourn the meeting. All in favor, say aye.
Aye.
Aye. Thank you. Meeting's adjourned.
Thank you.
Welcome to the
Made it.
Realize that lady